Washington's housing market just did something it almost never does. It stopped moving. Not rising, not falling, just stalling. On paper, that might look like stability, a breather, a moment of calm after years of volatility. But that's the surface level truth, the one everyone sees, the one that's easy to trust. The deeper truth, the one almost no one is talking about, is very different. A stall is never the end of a cycle. A stall is the setup. It's the moment where hidden pressures tighten, where the signals begin to shift, and where the next phase quietly forms beneath the statewide averages. And right now, that setup is pointing directly at 2026. Prices across Washington state are hovering in a tight band. Median values are drifting downward by less than 1% year over year. Inventory looks normal. Days on market appear stable. Nothing jumps out. Nothing alarms you. Nothing screams, change is coming. But that's exactly the problem. Markets rarely shift when things look chaotic. They shift when things look calm. Because calm is when pressure becomes invisible. In 2025, Washington isn't overheating. It isn't collapsing. It's tightening. Quietly, unevenly, structurally. And every time Washington has entered a stall like this, a stall where absorption thins, where buyers hesitate, and where sellers cling to price memory, it has been the prelude to the next major shift. Sometimes it becomes a soft reset, sometimes a segmented correction, sometimes a plateau that masks county-level reversals. But it always leads somewhere. The signals aren't loud yet, but they're already visible, just not in the statewide averages. They're hidden in the counties, in the neighborhoods, in the buyer behavior that never shows up in headlines. This moment, this stall, isn't about 2025. It's about the setup forming underneath it and the trajectory that leads into 2026. Washington's housing market didn't stop by accident. It stopped because pressure met resistance, and that combination always reveals something. Now we escalate. Stalls are deceptive. They look safe. They feel stable. But in real estate, a stall only means one thing: the forces that normally push prices upward and the forces that normally pull them downward have locked into a temporary stalemate. And whenever that happens, something underneath is shifting, always. Think of Washington's market like a three-layer system. The statewide trends, the averages that smooth everything out, the county dynamics, where the real signals begin, and the neighborhood behavior, where the early warnings appear first. Right now, those three layers are misaligned. At the statewide level, it is flat, but in the counties there is divergence, and in the neighborhoods there is early movement hiding in plain sight. King County stabilizing artificially, Pierce County showing early turn behavior. Snohomish County lagging in a way that historically precedes a shift. Kitsap, Thurston, and Spokane showing signals that contradict the statewide narrative. This isn't noise, this is the structure bending. A micro story makes it clearer. A Tacoma seller lists at a price aligned with 2023 comparable sales. Traffic is light, showings are quiet, one low offer trickles in. They decide to wait. 2 weeks pass, nothing. Not because the home is mispriced for last year, but because absorbing today's payment at today's rates is shifting from possible to difficult. That's how stalls behave, not with drama, but with silence. In Snohomish, buyers widen their search radius, only to discover that cheaper areas aren't offering real relief. In King County, homes still move, but only at the right price. In Kitsap, seasonal demand behaves unpredictably. In statewide, sales volume -- the most honest indicator is drifting. Pending sales are down over 4% year over year. This is why stalls matter, because every stall is a mask, hiding the divergence that eventually becomes the next phase. Next, we zoom out. Before we examine King, Pierce, and Snohomish individually, we need the macro vantage point, because Washington's stall is happening at the intersection of rate pressures, affordability ceilings, wage trends, and migration patterns. Here is the suppressed truth. Washington is too expensive to surge and too supply-constrained to fall. That's why it stalls. Rates hovering in the mid-sixes. Affordability index sitting near 60, one of the most strained points in years. Wage growth slowing relative to housing costs. Migration positive, but far below its peak. Construction pipelines constrained by labor and cost. And yet, prices are flat. This is not stability. It's the affordability ceiling hitting the supply floor. Buyers can't stretch further. Sellers won't retreat yet. Builders can add meaningful volume. Investors aren't shedding inventory. Gridlock. But within that gridlock, the structure is changing. A Seattle tech worker earning a strong salary begins searching for a mid-tier home. Last year, a payment at 6.2% was manageable. Now at 7%, it becomes a deal breaker. Not because the price rose, but because the psychological payment threshold was crossed. Absorption shifts before prices do, always. Inventory is drifting upward in specific brackets. Days on market are flat in some counties and rising in others. Sales mix is changing. Buyer depth is thinning, not collapsing, thinning. Thinning demand plus resistant prices equals stall. Let's dissect the engine of the state, King County. King County often lies to us. If you look at the median price, you see resilience, you see strength. But if you look at the transaction volume, you see the cracks. The stall in King County is unique because it is largely artificial. It is being propped up by a phenomenon known as the lock-in effect, but in Seattle, it's more aggressive than the national average. Why? Because the delta between a 3% mortgage and a 7% mortgage on a $1.2 million home isn't just a budget adjustment, it's a lifestyle demolition. So sellers aren't selling, they are renovating, they are holding, they are renting out their basements. This lack of new listings creates a false floor under prices. It makes the market look competitive, even though demand has actually plummeted by double digits compared to the peak years. But it's a mirage. We are seeing bidding wars on the few turnkey homes that hit the market in Bellevue or Green Lake. But don't mistake scarcity for strength. Those bidding wars are happening among a much smaller pool of buyers. The danger in King County isn't a crash in value. The danger is liquidity. If you need to sell in 2025 and your home isn't perfect and you don't price it ahead of the curve, you might find that the market has simply vanished. The tech buyer, the avatar that has saved this market for a decade, is changing too. With RSU packages fluctuating and layoffs still echoing through the sector, caution has replaced FOMO. King County is the fortress, but even fortresses run out of supplies during a siege. And right now, the siege is interest rates. Now move outward to the commuter belts, Pierce and Snohomish counties. This is where the stall feels different. This is where it feels heavier. For 5 years, the narrative was simple. Drive until you qualify. If Seattle is too expensive, go to Everett. If Everett is too much, go to Marysville. If the east side is out of reach, go to Bonnie Lake or Tacoma. But in 2025, that strategy has hit a mathematical wall. The cost of commuting, gas, time, vehicle wear, combined with home prices that rose 40% in 3 years, plus interest rates that doubled the payment, has erased the discount. The drive till you qualify buyers are exhausted. They aren't buying. They are renewing their leases. Look at the data in Pierce County. Inventory is accumulating faster here than in the core. Why? Because the buyer pool here is more rate sensitive. They don't have $200,000 in stock to vest. They have wages, and wages haven't kept up with the mortgage math. In Snohomish, we see a similar pattern, but with a twist. Active inventory in Snohomish has spiked, up nearly 42% year over year. That is a staggering number. Sellers in Snohomish are often retirees looking to cash out and move to Arizona or Idaho. But they are finding that the buyers who would normally replace them, the young families from King County, can't qualify for the loan on the exit price. This creates a deadlock. The chain is broken. And when the chain breaks in the commuter counties, inventory begins to stack. First, it's the homes with bad layouts. Then it's the homes on busy streets. Then it's the average homes. This stacking effect is the precursor to price softening. It's happening now, week by week, active listings creeping up, sold listings creeping down. The gap widening. There is a third player in this stall that we must acknowledge, the investor. Between 2020 and 2022, investors bought a staggering amount of Washington real estate. Small landlords, BRRRR strategists, institutional buyers. But the math of 2025 is brutal for them. Rents in Washington have softened or plateaued in many submarkets. Taxes are up, insurance costs have skyrocketed, and the cost of capital, the loan interest, is crushing cash flow. We are starting to see the capitulation listings. These are formerly rented homes hitting the market because the owner is tired of feeding the property every month. Why does this matter? Because investors don't have emotional attachment. They don't care about testing the market. They price to sell. When investors start unloading inventory, they undercut the neighborhood comparable sales. They drag the average down. We are seeing early signs of this in the secondary markets. It's a slow leak right now, but if the economy wavers, that leak becomes a stream. Let's move away from the data for a moment. Let's talk about the psychology, because markets are, fundamentally, just people making decisions. The psychology of 2025 is defined by one word: waiting. Buyers are waiting for rates to drop. Sellers are waiting for prices to bounce back to the peak. Builders are waiting for costs to stabilize. It is a giant game of chicken. But here is the harsh reality of economics. Time is not neutral. For a buyer, waiting might mean saving more cash, but it also means watching prices potentially creep up if rates do drop. For a seller, waiting is dangerous. Every month a home sits, it becomes stale. The market asks, what's wrong with it? And for the market as a whole, waiting builds up latent energy. Think of a dam. The water level is rising behind the wall. That water is the pent-up demand of millennials who want to buy and boomers who need to downsize. They are stuck behind the wall of high rates and low inventory. When that dam breaks, whether it breaks because rates drop or because a recession forces selling, the resulting flood will be chaotic. The stall is simply the water rising behind the dam. It looks calm on the surface, but the pressure on the concrete is immense. So, where does this lead? If the stall is the setup, what is the payoff? As we look toward the horizon of 2026, we can model three distinct trajectories for Washington State. Scenario 1, the soft landing release. In this version, mortgage rates drift down slowly into the mid-fives. Inventory unlocks gradually. Buyers return in waves. Prices appreciate at a boring, historical norm of 3 to 4%. The stall resolves into a healthy walk. This is the outcome everyone is hoping for. The Federal Reserve threads the needle. Washington's economy stays robust. But hope is not a strategy. Scenario 2. The rate lock grind. Rates stay higher for longer. 7% becomes the new normal for 2 more years. In this scenario, the stall turns into stagnation. Prices in the outer counties, Pierce, Thurston, Kitsap, begin to erode slowly. Real terms value drops as inflation outpaces appreciation. Volume hits generational lows. The real estate industry contracts massively. This is a slow bleed, painful but not explosive. Scenario 3. The volatility snap. This is the one the data whispers about. In this scenario, something breaks in the broader economy. Unemployment ticks up in the tech sector or construction. Forced selling begins. Inventory spikes suddenly, jumping 30 or 40% in a quarter. Simultaneously, buyers retreat in fear. This breaks the stall violently. Prices correct sharp and fast, resetting the affordability index to match wages. It's a correction, and historically, Washington is due for one. Which scenario are we tracking toward? Look at the shadow inventory. Look at the days on market in the suburbs. They suggest we are drifting between Scenario 2 and Scenario 3. The soft landing looks less likely with every month that affordability remains crunched. Next, we zoom out. Washington's housing market is currently a held breath. But you cannot hold your breath forever. Eventually, you have to exhale or gasp. If you are watching this, you need to understand one thing. The averages are useless to you now. Do not look at Washington real estate. There is no such thing. There is only your neighborhood, your price bracket, your timeline. If you are a buyer, the stall is your opportunity to negotiate. Silence is your leverage. Use the fear. Make the aggressive offer. The worst they can say is no. But right now, many sellers are tired of hearing nothing at all. If you are a seller, the stall is a warning. Price perfection is the only defense. You cannot test the market in a stall. You are either in the market or you are invisible. Thinning demand plus resistant prices equals stall. And in Washington, 2025 is the affordability ceiling year. 2026 is when the consequences emerge. If you found value in this breakdown, share it with someone in Washington who's buying, selling, or planning their next move. And in the comments, tell me your county, because your local data might appear in a future breakdown. Subscribe for upcoming market breakdowns and early warning alerts.